All right, everybody was paying attention. At 2 o'clock this afternoon, the Federal Reserve moved, as expected, to raise interest rates for the 7th time this year. But this hike was a little bit smaller. It was 0.5% instead of 0.75%. So now it's time for Mike on the Money. Mike Giordano with Williams Wealth Management, financial advisor, here to kind of answer some of those questions. So is the fact that this was a 0.5% hike, is that saying that maybe the Fed feels like their plan to get down to 2% is working?
Well, they think in some ways it's working, but what the real reason for stepping down was just basically they don't really want to crash the economy too hard. And so since they know all these things operate with a lag, they basically are like, we did a lot of hiking already. Let's just try to slow the pace and see, what all these previous hikes amount to. And this way, if we can avoid a recession, hopefully, that will be still in the cards.
Okay, and a lot of people ask him about avoiding the recession. So the goal for the Fed is to get inflation to 2%. First of all, is that reasonable? Is that achievable? And secondly, what did he say about avoiding recession? They're hoping that soft landing might work.
Well, he was asked about the 2% as well today, and basically he's like, we're not going to move the goalpost, and it'd be really bad if he said we're going to move the goalpost when they're losing the battle against inflation.
Yeah.
When it actually comes to a recession, he kind of dodges, saying nobody can really predict whether we're going to get a recession, and if we get a recession, whether it's going to be a shallow recession or a deep recession, and that's why they're committed to continuing to raise rates. They were only expected to raise maybe another 0.25% in the new year, but now they're saying they're going to raise interest rates by another 0.75% in 2023, and most importantly, that they don't expect to cut rates. And the market keeps going, we want you to cut rates, we want you to cut rates, and so far they're saying that's not in the cards for 2023.
Okay, so all of your people are coming to you and they're saying, Mike, you have my money. I need to make good decisions. I'm very worried about the markets, but the markets have been performing well. Not so good today. They didn't like this news. What are you telling us to do with our money right now? Do we hang in there?
Hanging in there and staying balanced are the keys to this. So even if you're somebody who likes to drive fast and you want to drive your investments fast, you got to think about what it's like to drive on a day like today, right? The rain coming down, fog, it's chilly, all those things. So dial it back. Even if you want to drive your investments fast, if you dial it back, you add a little bit more balance. Even if we get a recession, bonds should act as that ballast against stock exposure. That didn't happen this year, but it should, come back into its rightful place, bonds. And so if you add some bonds into your portfolio, they'll give you a little bit more stability.
Okay, and quickly, for people with a 401k plan, leave in the maximum you can contribute or take some of that out and put it somewhere else? If
you have the money, if you're able to take care of all your bills and everything and you've got that added cash flow, continue funding at the same levels you've been funding. Okay, great. Mike Giordano, thanks so much. Merry Christmas. Merry Christmas to you, Jane.
We'll be right back.